Hey everyone, welcome into another edition of Market Takes. Thank you so much for being with us. I know you could have been anywhere in the world, but you're here with me. I appreciate that. I am Dion Raboan, reporter at the Wall Street Journal, and today we are digging into the CPI Consumer Price Index inflation report. Just came out this morning. It is moving markets. We're going to talk about that. But of course, you know, we always talk about the report. We're going to dig into the report, talk about what it means, talk about what it means for markets, what it means for consumers, the economy, all that good stuff. We're going to talk about what the report showed and how that compared to expectations. Talk about the major takeaways from this report, and I think there are a few of them, and they depend on kind of how you're looking at, what your lens is for looking at this report. We're going to talk about how that aligned with the inflation trend we've seen in recent months and what that sets up for the end of the year as we're already in Q4. We're going to talk about the market reaction, stocks, bonds, commodities, crypto. All those things had a reaction to this report, some much more than others. We're going to get into that in just a second. We're going to talk about how this influences the Federal Reserve, because we all know the Federal Reserve is everything when it comes to markets, investing, and really what's happening with the economy. And we are going to talk about, of course, the big takeaway and what comes next. We're going to talk about the upcoming data, because as we know, as investors, we are always looking forward, even though it is backward-looking data. So without further ado, let's get into it. I want to throw a chart up here on your screen, and that is going to be a chart of what we've seen from the CPI report. Going back to the beginning of 2022, you see there that consistent decline in the year-over-year pace of inflation. Well, now what we've seen over the past 3 months, and now this is lining up, and inflation didn't increase. It was 3.7% in September, 3.7% in August. So didn't rise again, but didn't decline again either. And so we have seen basically the equivalent of 3 straight months of rising inflation on CPI. CPI gone up ever since June when it hit that 3% level. Then it's moved up, and now it's coming in at 3.7% year over year. So this chart really just illustrating that inflation is not continuing that pace downward. It isn't picking back up. It's not spiking higher the way it was in 2022, but we also aren't seeing that lower movement in terms of overall inflation. Now, let's put another chart up here on your screen that shows something a little bit different, and that's core CPI inflation. And what we see there is a continued lower trend, that trend that the Federal Reserve is looking for. And this has really been the first time that we've gotten that consistent move lower on core inflation. You see there, core prices had really held up for most of the year, and since about the middle of the year, since that May time period, we have seen a consistent decline, and we have seen prices moving lower each month on a year-over-year basis on the core aspect. Now, core strips out food and energy prices. Now, I know some of you are saying, but wait, food and energy, that's most of what I spend my money on. Well, it strips those out because those can be volatile. It's not something the Federal Reserve has a lot of control over. So they take those out to say, hey, what's the core pace of inflation doing? And that is moving down. That was 4.1% this month, year over year, rising at just 0.3% month over month. So coming down pretty consistently. And that chart just illustrating, again, when you look at overall inflation, that's picking back up and moving back towards 4%. When you look at core inflation, which is held above 5 and now is holding above 4, but that's moving down towards 4% overall inflation. So, or 4% core inflation, excuse me. Those charts really just showing the contrast in what we're seeing in terms of the overall pace of inflation, which is just what everyday people are spending on all their goods and services, and core inflation, which strips out food and energy, because we know food and energy are doing a lot of work right now in terms of pushing prices higher. But we're going to get into a little bit more of the details on that. I think you'll be surprised at some of the details that we've got. This report was right on the numbers, suggesting, again, overall inflation continues to hold above 3.5%, not moving towards the Fed's 2% inflation target. It is not doing that, but core inflation overall did. We have seen the Fed really talking up core inflation, saying, hey, core inflation is doing what we want. These inflation readings on CPI, on PCE, the personal consumption expenditures, which is the inflation report the Fed watches more closely, they're saying those things are doing what we want. We are seeing from those reports what we want to see. But overall, for consumers, for everyday Americans, inflation is not doing what we want. And we're going to get into that in just a second. So how you view today's report is all about the narrative. It's all about the lens that you look at it through. The Fed has said its focus is core inflation, which is falling, but overall inflation is rising. And we see that in the Fed's consumer survey that just came out yesterday, the New York Fed's consumer survey, showed that inflation expectations are rising. So everyday Americans, regular folks, when they say, hey, what do you think inflation is going to be like a year from now? Where do you think prices are going to be? Those are rising, and people are saying they expect more inflation. That has a number of important effects, and we'll talk about that in just a sec. But like I said, the New York Fed's consumer survey earlier this week, 1 and 3 year inflation expectations both rose in September, and those are rising right in line with overall CPI, right in line. The latest report showed 3.7% expected inflation for the 1 year period. That's exactly in line with the report that we got from CPI. So that really showing that consumers aren't that concerned about where core is or what the Fed's saying. Consumers are looking at their wallets, their pocketbooks, their credit card statements. They're looking at those gas prices, what they're paying at the grocery store, and saying, we think inflation is going to start picking back up. When people expect higher prices, they're willing to pay higher prices, and companies know that, so they start raising their prices, and that's what really sends inflation up. We've talked about this a number of times here on Market Takes. I've done a number of videos. Companies really benefit from a high inflationary environment. When inflation is high, people think, oh, well, prices are just going up. I just got to pay the higher prices. And companies take advantage and they raise those prices, and that gets inflation rising higher. So we have seen that. We saw that a lot in 2021, 2022, and we could be seeing it more now. Companies have thrown in the towel a lot, but we did see the PPI report, producer prices, which is essentially what businesses are paying for the stuff they buy. That rose yesterday in the report that we saw. So we are seeing companies getting higher prices or having to pay higher prices. They still feel like they can generally pass those on to consumers, so we could see inflation start to pick back up. Let's talk about the major takeaways from this report. First off, the trend has been up the previous 2 months, and September was actually the biggest increase, or excuse me, July was the biggest increase that we saw since July of 2022. So the month over month increase we saw in August was the biggest since what we got a year before, and that's showing that overall inflation is just not going away. A lot of that being driven by food prices. Energy, actually, if you look at the energy index, if you look at oil prices, those are actually negative year over year. So what we're moving towards is a place where oil could start actually pushing up inflation instead of bringing down inflation on a year over year basis. Now that's important because remember, if you think about last year, oil prices were going up and up and up because we had just sort of gotten into this Russia-Ukraine conflict, or that conflict had just started. That was pushing up food prices, oil prices to a very high level. They've come down since then, but they are starting to rise again. So when you compare it to a year before, prices are still lower than they were, especially when you talk about oil and energy, fuel, gasoline, all those things. But those are starting to rise, and in the next few months through the end of this year, we could start to see energy and oil prices actually pushing inflation up. That could push inflation back towards that 4% level. Again, double the Fed's 2% inflation target. And you could see core prices keep coming down. The Fed says, oh, watch core, look at what's happening in the core prices. But regular average everyday Americans are going to be saying, wait, I see prices going up. I'm having to pay more to fill up my car or truck. I'm having to pay more to heat my home. I'm having to, pay more money out every month. I think inflation's going to keep going. That's going to be definitely something to watch. Also remember that oil prices affect everything. They affect the price of everything else. They influence shipping costs, delivery costs, heating and oil costs. Remember, heating and energy costs, heating and cooling costs. When you get something, odds are it was delivered by a truck, right? Or delivered by an oil tanker or a big, something like that relies on oil. Airplane, all those things rely on fuel. And when those prices go up, well, airline companies raise prices. Trucking companies, UPS and FedEx raise prices. That's what we're seeing right now. And so those oil prices are a big piece of this. Don't forget that Middle East conflict could push up energy prices. We've already seen that. We'll talk about that in just a moment. Could also push up food prices like what we saw with the Russia-Ukraine conflict. The biggest drag on overall inflation was from used car and truck prices. That was down 2.5% month over month and down 8.8% year over year. But those could also start to rise because of this UAW strike, the United Auto Workers striking at the big three automakers here in the US. So All the things that have been pulling inflation down, oil prices, used cars, food prices have been coming down a little bit. Those could start to push inflation back up, and housing, as we see those rates rise. We'll talk about that as well in just a minute here. But all of those things could start to push inflation up in the future. That's what we're seeing in this report. Even though core inflation has been declining, and it declined the prior 2 months, this really is, or decelerated, I should say, because core inflation hasn't declined. It's still around 4%. It's slowing down. Even though this continued that trade, overall we could see inflation start to pick back up. The big picture here is that the headline versus core numbers tell us that inflation is going down to the things the Fed controls, the things that they are able to control. But the biggest piece there is wages. Let's talk for just a second about real wages. Wages when adjusted for inflation, those have fallen for the past 2 months in a row. So real average weekly earnings were down in September. So when you look at what people are earning, what they're bringing home, and then how much that's able to buy, what they're able to go out and do with that, well, people are earning less. And this could be contributing to a drag on consumer sentiment, a drag on markets. This is all big, and we have seen, again, a new trend. It's only 2 months, so 2 months a trend does not make, but certainly something to watch. It looks like right now the biggest losers of Fed policy are working Americans. They're starting to see their paychecks in terms of the real wages they earn, what they can go out and buy with those wages, starting to shrink. And that's what's really being impacted by Fed policy, not so much overall prices. The most important number in this report really depends on how you look at it. For the Fed, we saw another decline in core inflation, things that their policies have a big effect on. They've been talking about it over and over and over. We focus on core inflation. We don't like to think about food and energy. Our policies can't have that much of an effect, but those things are having an impact in terms of food and energy prices are having a real impact on inflation expectations, American psyche, and those paychecks. The Fed's policies are having a big impact on our paychecks. The energy index overall was down 0.5% year over year, but it was up 1.5%, and it rose for the 4th month in a row. So when you're thinking about inflation, you've got to think about oil prices, especially when it comes to those inflation expectations. Let's take a look at what's going on in the markets right now. I want to throw a chart up here on your screen so you can see exactly what we're seeing in the markets. You see right there, the Dow is down about 0.3%. You see the S&P 500 negative, but the NASDAQ is actually up for the day. You're seeing a big increase in those tech company stocks moving in the opposite direction of the overall market. But I want to talk about bonds. You know I love bonds. If you watch Market Takes, you know we're all about bonds here because bonds is where the real action is. Let's talk about this 2-year note right here. Look at the big jump in yields we saw right after the release of this CPI report. We are back above 5% on the 2-year. The 2-year is important because it aligns with what people expect the Federal Reserve to do, what people expect the Fed to do. And we are seeing a big increase, a big pickup. This is much more pronounced than the increase we saw on Jobs Day when that big jobs report came out, showed the U.S. added about double or twice as many jobs as expected. We saw a pretty muted reaction from the 2-year note because folks were saying, oh, we don't think that's going to change what the Fed's going to do. We're seeing the opposite effect here. We're actually seeing a big increase in the 2-year. Folks saying, this may change things for the Fed. Let's also take a look at the 10-year, and you see the same reaction. We're seeing that across markets, just a big pickup. 10-year and the 30-year note, also a big increase right there. Those are showing what expectations are for overall economic growth and overall inflation in the long term. So folks, sell those notes, the yields rise because they think, okay, inflation's going to be higher than we thought for longer than we thought, and this could boost growth but also boost inflation. And as we've seen in the last couple months, real wages have gone down. That just means inflation grows a lot more than growth. So what you're looking at here is a bigger increase on some of these others, on some of the longer term notes than on the shorter term, but we are seeing an increase or a pickup right there in that 2-year. Let's talk really quickly about currencies because there was also a big move in the dollar. You see the WSJ dollar index up about 0.5%, the US dollar index similar up about 0.5%, and the euro down a little more than 0.5%. This all just correlates again to Fed policy. Folks thinking the Fed is going to have to raise rates more. That's going to strengthen the dollar, weaken the euro, and that's just really going to have a big impact on the overall economy. Currencies are where you see that. Not a big reaction in the commodity markets, but I do want to point to what we're seeing in crude futures. This is WTI. This is Brent right here. Same reaction Oil prices are going up. And when you see that happening, that could have a big impact on inflation. So I just show you all that to illustrate kind of the changes that we are seeing in markets and what's happening in markets overall right now. And we are seeing a big reaction, especially in bonds, and bonds are driving everything right now. If you're not watching the bond market, you're just watching stocks, listen, step your game up. This is what Market Takes is all about. We're getting your game right, getting you on point, getting you where you need to be. Watch that bond market because that's what's driving everything. Listen, I spoke with San Francisco Fed President Mary Daly last week, and she was telling me this line that the Fed is pushing. We want to maintain optionality. We don't want to lock ourselves in. We don't want to say, oh, we don't need to raise rates this year because we might need to raise rates this year. Well, this report, I think, is going to strengthen some folks who say we need to raise rates again this year, and it's also going to strengthen those folks who say we don't need to raise rates this year. This upcoming Fed meeting at the end of this month, beginning of next month, October 31st, November 1st, we'll hear from Fed Chair Jerome Powell. On the 1st, of course, we'll be here with Market Takes, breaking it all down for you. But at that meeting, I think you could start to see some dissension, some folks starting to disagree about what to do at the Fed's meeting in December. So look out for that. This mixes with the strength that we've seen in the labor market. But again, back-to-back negative real wage growth. And we saw in that latest jobs report a decline in terms of average hourly earnings. We have seen at the Atlanta Fed's wage tracker 6 straight months of declining real earnings on a 3-month basis. So keep your eye on that. Big increase in overall jobs, but a big decline or a deceleration in earnings for U.S. workers. That's the big thing. Last chart I want to put up here on your screen is what's going on with mortgage rates, because that relates to housing, that relates to, of course, inflation. Look at the huge increase on your screen there in terms of the 30-year fixed rate mortgage. That's what most Americans have. That is just rising significantly this year. After kind of slowing down into the end of 2022, we have picked up in a big way. That goes back to bonds like I just showed you on the chart. And we're just seeing that pick up. That is raising housing costs significantly. And as we're seeing that, that's going to push up inflation as well, because it's going to keep those shelter costs from going down. Listen, if landlords have to pay a lot more money to buy a house, to finance a house, or to finance an apartment condo, they're going to charge more money to people living in it. This is really just going to push up prices as the prices for housing stay high. As demand has diminished a little bit, but it's not falling off a cliff, you're seeing what folks have to pay for housing could start to, or could continue to pick up and rise through this year. And this chart just illustrates the way that mortgage rates have risen. That, of course, influences overall prices. Listen, big picture takeaway from this report is inflation is not dead. It's not going away. It's coming down, but it's not going away. Don't let the Fed dictate your focus. The way we're looking at inflation, you've got to look at overall inflation, because that's picking up. That relates to what you're going to pay at the pump, the grocery store, what you're going to pay on those monthly utility bills, all that. All the things that are included from core prices are all the things that look like they're going to increase in price soon. That's used cars, that's oil and gas, that's food, and that's housing. Housing actually is included in the core price index, but you get what I'm saying. Here's what comes next. We get the consumer sentiment reading, or the consumer sentiment index tomorrow. That's out on Friday. Watch that. Consumer sentiment, very important to the Federal Reserve. We get the retail sales report. That's out on Tuesday. We're going to be right here on Market Takes breaking all that down for you. So please be with us Tuesday morning, 10 a.m. Eastern time. We'll be right here on Market Takes. Don't go anywhere. Last thing before we get out of here. I am interviewing San Francisco Fed President Mary Daly on the podcast, WSJ's Take on the Week. It's coming out Sunday at 6 a.m. Check it out, WSJ's Take on the Week. We cut through the noise to explain the major business and financial news that may move markets. Also, you can make smarter investing decisions. Subscribe wherever you get your podcasts. And that's going to do it for us here on Market Takes. I am Dion Rabowen, reporter at the Wall Street Journal. We will be right back here on Tuesday. We hope you'll join us, and we'll see you next time.